paper company that couldn't print money. The rise and fall of Arjo Wiggins Appleton. In 1854, when Charles Dickens was penning Hard Times and the Industrial Revolution was transforming Britain, a paper company was born that would survive 2 world wars, witness the birth of modern publishing, and endure for over a century and a half. Arjo Wiggins Appleton wasn't just any paper manufacturer, it was a colossus that supplied the very medium upon which literature, newspapers, and business communications flourished across Europe and beyond. The company's roots traced back to multiple British paper mills, with the Wiggins Teep component dating to 1761, making it one of the oldest industrial enterprises in Britain. At its peak, this paper giant employed over 8,000 people across dozens of facilities in Europe, North America, and Asia, producing everything from high-end writing papers to specialized industrial materials. The irony is palpable. A company that spent 154 years helping others print their stories couldn't write a successful ending to its own. Arjo Wiggins Appleton represented the epitome of old-world manufacturing excellence, yet it became a cautionary tale of what happens when traditional industries refuse to acknowledge that the world beneath their feet has fundamentally shifted. The company's golden age stretched from the late 19th century through the 1980s, riding the wave of mass literacy, expanding global commerce, and the explosion of printed media. Wiggins Teep, as it was known before its various mergers, became synonymous with quality paper throughout the British Empire and beyond. During World War I, the company pivoted to produce specialized papers for military communications, demonstrating an early ability to adapt to changing circumstances that would later abandon them entirely. By the 1920s, they were supplying paper to major publishing houses across Europe, their mills running around the clock to meet the insatiable demand of newspapers, books, and business correspondence. The company went public in 1919, raising capital that funded aggressive expansion across continental Europe. Throughout the post-war boom of the 1950s and 1960s, Wiggins Teep established manufacturing facilities in France, Germany, and Belgium, positioning itself as Europe's premier paper supplier. The 1970s brought the first major transformation when Wiggins Teep merged with British paper manufacturer Appleton, creating Wiggins Teep Appleton. This merger was followed in 1990 by the acquisition of the French paper company Arjo, forming the unwieldy Arjo Wiggins Appleton that would carry the company to its doom. At its zenith in the early 1990s, the company controlled nearly 15% of Europe's fine paper market, generating annual revenues exceeding £2 billion. The seeds of destruction were planted during the company's period of greatest expansion. Arjo Wiggins Appleton's management, intoxicated by decades of steady growth and market dominance, made a series of catastrophic strategic decisions that would prove impossible to reverse. In 1998, the company was acquired by Sequana Capital, a French conglomerate that loaded it with debt to finance further acquisitions and modernization efforts. The debt burden increased the company's annual interest payments to over £50 million, creating a fixed cost structure that left no room for error when market conditions deteriorated. Management continued to invest heavily in traditional paper manufacturing equipment, including a disastrous £60 million upgrade to their Stonywood mill in Scotland in 2003, just as digital communications were beginning to erode demand for their core products. The company's leadership, steeped in generations of paper industry tradition, fundamentally misunderstood the nature of the digital revolution, viewing it as a temporary trend rather than a permanent transformation of how people communicate and consume information. They doubled down on premium paper products, believing that quality and heritage would insulate them from technological disruption. Between 2000 and 2005, while paper consumption in Europe declined by 12% annually, Arjo Wiggins Appleton increased production capacity by 8%. Creating a massive oversupply that crushed profit margins across their entire product line. The digital revolution didn't arrive overnight, but its impact on Arjo Wiggins Appleton was swift and merciless. Email adoption accelerated dramatically in the early 2000s, with business email volume increasing by over 300% between 2000 and 2005, directly replacing the business correspondence paper that formed a core part of the company's revenue stream. Newspaper circulation began its inexorable decline as readers migrated to online news sources, eliminating millions of tons of annual newsprint demand that had sustained paper manufacturers for over a century. The rise of digital document management systems meant that offices, law firms, and government agencies that had been reliable bulk purchasers of printing paper suddenly slashed their orders by 50% or more. Online banking and electronic billing further eroded demand for the specialized papers used in financial communications and statements. Even the publishing industry, long a reliable customer, began embracing print-on-demand technologies that required smaller, more frequent orders rather than the massive print runs that had been the paper industry's bread and butter. Arjo Wiggins Appleton's management watched helplessly as their customer base evaporated, yet they continued operating under the assumption that demand would eventually recover. The company's annual reports from 2004 to 2006 consistently predicted market stabilization within 12 to 18 months, a timeline that kept getting pushed back as reality refused to conform to their expectations. By 2007, the European fine paper market had contracted by 30% from its 2000 peak, but Arjo Wiggins Appleton still operated as if they were serving the paper-hungry world of 1990. Competition from lower-cost manufacturers in Asia and Eastern Europe created a perfect storm that overwhelmed the company's already precarious position. Chinese paper manufacturers, subsidized by their government and operating with labor costs a fraction of those in Western Europe, began flooding global markets with competitively priced products that met the quality standards demanded by most commercial users. Indonesian and Malaysian manufacturers leveraged their proximity to raw materials and favorable exchange rates to undercut Arjo Wiggins Appleton's pricing by 20 to 30% on commodity paper grades. The expansion of the European Union to include countries like Poland and Czech Republic brought new competitors with modern facilities and lower operating costs directly into the company's home market. Arjo Wiggins Appleton's legacy manufacturing facilities in Britain and France, some dating back over a century, couldn't compete with newer, more efficient plants built from scratch with modern technology. The company's premium positioning, once a source of pricing power, became a liability as customers increasingly prioritized cost over prestige in their paper purchasing decisions. Environmental regulations in Western Europe imposed additional costs on Arjo Wiggins Appleton's operations, requiring expensive upgrades to reduce emissions and waste, while competitors in less regulated markets operated without these constraints. Currency fluctuations further complicated matters, as the strong British pound and euro made their exports more expensive while making imports from Asia more attractive to European buyers. Between 2005 and 2007, Arjo Wiggins Appleton lost major contracts worth over £100 million annually to lower-cost competitors, forcing them to slash prices to retain remaining customers and destroying what little profitability remained in their business model. The financial crisis of 2008 delivered the knockout blow to a company already staggering from years of declining demand and mounting debt. Credit markets froze, cutting off the company's access to the revolving credit facilities they had used to manage cash flow fluctuations inherent in their capital-intensive business. Banks that had previously been willing to refinance the company's debt began demanding immediate repayment, creating a liquidity crisis that management couldn't resolve. Customer payment terms extended as businesses across Europe struggled with their own financial difficulties, creating a cash flow nightmare for Arjo Wiggins Appleton, which still had to meet weekly payrolls for over 7,000 employees. The collapse of Lehman Brothers in September 2008 triggered a broader credit crunch that made it impossible for the company to secure the emergency financing needed to weather the crisis. Orders from surviving customers plummeted as businesses postponed non-essential purchases and reduced their inventory levels to preserve cash. The company's debt-to-equity ratio, already alarming at 4-to-1 before the crisis, became completely unsustainable as revenue fell 30% in the fourth quarter of 2008 alone. Sequana Capital, Arjo Wiggins Appleton's parent company, was itself struggling with debt problems and couldn't provide the hundreds of millions of pounds needed to keep the paper manufacturer afloat. Asset sales, including the disposal of the company's profitable specialty papers division, provided temporary relief but eliminated the most valuable parts of the business and reduced future earning potential. By November 2008, the company was burning through cash reserves at a rate of £10 million per month with no prospect of returning to profitability in the foreseeable future. The end came with startling swiftness for a company that had survived the Industrial Revolution, 2 world wars, and countless economic downturns. On December 15, 2008, Arjo Wiggins Appleton's board of directors met in emergency session and voted unanimously to file for administration, the British equivalent of bankruptcy protection. The announcement sent shockwaves through the European paper industry, where Arjo Wiggins Appleton had been considered too big and too established to fail completely. Administrators from PricewaterhouseCoopers took control of the company's operations, immediately beginning the process of liquidating assets to pay creditors who were owed over £800 million. The company's stock, which had traded as high as £12 per share in 2000, became worthless overnight, wiping out pension funds and individual investors who had believed in the stability of the paper industry. Within 60 days of the administration filing, all of the company's manufacturing facilities across Europe were shuttered, leaving 7,800 employees without jobs just as the global recession was reaching its peak. The company's Stonywood mill in Scotland, where paper had been manufactured continuously since 1770, fell silent for the first time in over 2 centuries. Longtime customers scrambled to find alternative suppliers, many of whom were also struggling with the same market conditions that had destroyed Arjo Wiggins Appleton. The liquidation process stretched over 18 months, with the company's assets ultimately selling for less than 20% of their book value, leaving creditors with massive losses and former employees with reduced pension benefits. The Arjo Wiggins Appleton name, which had once commanded respect throughout the global paper industry, disappeared forever when the last assets were sold in June 2010. The collapse of Arjo Wiggins Appleton represents more than just another corporate failure. It embodies the brutal reality of technological disruption in traditional industries. The company's management made the fatal error of treating digital transformation as a cyclical downturn rather than a structural shift, continuing to optimize for a world that no longer existed while ignoring the world that was emerging around them. Their commitment to traditional paper manufacturing excellence became a liability when customers no longer valued those qualities enough to pay premium prices. The debt-financed expansion strategy that had worked brilliantly during periods of growth became a death sentence when revenues declined, demonstrating how leverage amplifies both success and failure in capital-intensive businesses. The company's geographic concentration in high-cost Western European markets left them vulnerable to competition from lower-cost regions, while their failure to diversify into growth segments like packaging or specialty materials eliminated potential escape routes. Environmental consciousness among consumers and businesses further accelerated the decline of traditional paper products, creating a values-based headwind in addition to the technological and economic challenges the company faced. The speed of the company's final collapse illustrates how quickly established businesses can unravel when multiple negative factors converge simultaneously. Perhaps most tragically, Arjo Wiggins Appleton's failure wasn't inevitable if management had recognized the changing landscape and acted decisively to transform their business model. Companies like International Paper and Stora Enso successfully navigated the digital transition by diversifying into packaging, reducing capacity in declining segments, and investing in new technologies like sustainable forestry and bio-based materials. The warning signs were visible for years before the final collapse. Declining order volumes, increased price competition, customer consolidation, and the obvious growth in digital communications. Yet Arjo Wiggins Appleton's leadership, perhaps blinded by their company's long history of success, chose to wait for market conditions to improve rather than acknowledge that fundamental change was necessary. The company's research and development spending fell to less than 1% of revenue during their final years, exactly when they should have been investing heavily in innovation and new product development. Their failure to build partnerships with technology companies or explore adjacent markets like digital printing services revealed a management team that had become isolated from the broader trends reshaping their industry. The company that had once been innovative enough to supply specialized papers for early aviation and military applications in the 20th century had lost the entrepreneurial spirit needed to reinvent itself for the 21st century. The story of Arjo Wiggins Appleton serves as a masterclass in how established companies can be destroyed by their own success and the assumptions that created it. For 154 years, the company thrived by perfecting the art and science of paper manufacturing, building deep expertise in production processes, supply chain management, and customer relationships that seem to create an impregnable competitive moat. That expertise became a trap when the fundamental premise of their business was undermined by technological change they couldn't control and refused to fully accept. The company's failure cost thousands of jobs, wiped out hundreds of millions in shareholder value, and eliminated a piece of British industrial heritage that dated back to the height of the Victorian era. Suppliers, customers, and communities across Europe felt the ripple effects of the company's collapse, demonstrating how the death of large corporations creates widespread economic disruption. Today, the sites where Arjo Wiggins Appleton once operated house everything from data centers to shopping complexes, a fitting metaphor for how completely the digital age has replaced the paper-based economy the company once served. The lesson for other traditional industries facing technological disruption is clear. Adaptation isn't optional, heritage isn't armor against change, and the companies that survive are those willing to destroy their own business models before someone else does it for them. Arjo Wiggins. Appleton's century-and-a-half journey from startup to industry leader to bankruptcy serves as both an inspiration for what's possible with persistence and innovation, and a warning about what happens when those qualities are abandoned in favor of protecting the status quo.